Good morning. It's Tuesday, the 27th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The Take: Why India should now think China plus two. I had an interesting conversation with Sharat Sharma, co-founder of iSpirit, a not-for-profit organization that is driving the product nation focus for India, centered around more new generation software products by addressing government policy, creating market catalysts, and helping product entrepreneurs. iSpirit is the brains trust behind the India Stack, which is a publicly available application programming interface or API that provides programmers with access to proprietary software applications that in turn enable integrating mobile applications with data stored and provided by the government to authenticated applications. Or put differently, it's the common link between a disparate set of programs and offerings that link many aspects of digital India, from payments to health and to access. It's also the complete set of APIs for developers. It includes the Aadhaar for authentication, eKYC documents, safe deposit locker for issues, storage and use for documents. Remember that when you open a bank account, you're somewhere using the India Stack for authentication and other digital signatures and so on. And of course, the Unified Payment Interface or UPI for financial transactions. Now, iSpirit is expanding the definition of product to think manufacturing and R&D, but that's for another day. In our conversation, he mentioned that while we've been thinking China plus one, which is to bring manufacturing that is being relocated or shifted around in supply chain shifts from China to India, could we or should we be thinking a few steps ahead? For example, should we be getting into the garment manufacturing race with China, or now be thinking of the machines that help make garments, as China did with Japanese and German sewing machines and created more sophisticated, programmable sewing machines which improved productivity for garment workers in, let's say, Cambodia? Of course, there is no either or in these cases, but it's a slightly different way of thinking. I thought maybe the term China plus two is more appropriate. So if the first phase was about plus one, where you substituted production and shifted it, let's say, to India, plus two is about thinking, how do you go one step ahead or several steps ahead or up the value chain? Because the plus one part, while useful in the short term, is ripe for cannibalization by someone else or will be quite soon. It's not that companies have not thought or are not thinking about this already. Some are, but maybe others are not. For offshore companies, India will always be seen as an arbitrage opportunity, whether in services or in products, at least first, including in, let's say, garments and, of course, IT services. But for India to gain clout, it has to think, position and present itself as a plus two player in many or each of these industries. There is much thinking going on in this space, which, like I said, I'll bring up another day. But till then, the question to ask is, can I think China plus two in my industry? And if so, what will that look like? And that brings us to the top stories and themes for the day. The stock markets catch the Fed fever ride on interest rate cut hopes. Oil prices rise once again on war tensions. Economists are polling lower GDP numbers for the first quarter. Why there is uncertainty hereon? Will Global Capability Centers or GCCs eat Indian IT services companies' lunch?
This is a Core Report with Govindraj Ethiraj.
The stock markets ride on Fed fever. Well, it was a day of some small records. The benchmark Nifty 50 ended higher for the 8th consecutive session, its longest run this year. While the gains were small, they were gains nevertheless. The push largely came from India's IT stocks that lifted the indices closer to record highs, following, of course, the Federal Reserve Chief's statement over the weekend suggesting that interest rate cuts were imminent. The Nifty 50 hit the 25,000 mark for the second time ever during the session and closed at 25,010, or up 187 points. The BSE Sensex ended 612 points to end at 81,698. The broader indices also ended well on Monday, including at record levels. Gold held near record highs on Monday thanks to a softer dollar and dovish remarks from US Federal Reserve Chair Jerome Powell, according to Reuters, which added that gold was about $2,524 per ounce, only about $7 short of the record high of $2,531 hit last week per ounce. On Wall Street, stocks rose slightly on Monday with the S&P 500 and Dow Jones Industrial Average near record levels as investors looked to push equities back to record high levels now that the Federal Reserve has indicated that rate cuts were forthcoming, according to CNBC. Oil prices are rising again. After slipping and staying soft in the last few weeks, oil prices rose again after Israel struck targets in southern Lebanon and the Hezbollah responded by firing missiles, all of which raised tensions once again in the Middle East, which provides about one-third of the world's crude oil. Brent crude prices came in touching distance of $80 a barrel once again as both geopolitical risks as well as the interest rate cut next month, or the likelihood of it, weighed on the markets. Over the weekend, Bloomberg reported Federal Reserve Chair Jerome Powell giving his most decisive signal yet that his inflation-fighting mission had been accomplished at his speech in Jackson Hole, Wyoming, and he said that the time has come for policy to adjust. Commodities traders told Bloomberg that while risks in the Middle East were building following the latest escalation, the markets were also becoming increasingly immune to these tensions, adding that this has been going on for almost a year and is yet to have an impact on oil supply. Why economists are predicting lower GDP for India in the first quarter? A Reuters poll has said that India's economic growth has likely moderated and grew at its slowest pace in a year in the April to June quarter due to lower government spending thanks to the election that concluded in June. Growth so far has been above 7% during previous quarters thanks to strong capital expenditure. In the April to June quarter, GDP or gross domestic product was forecast to have grown at about 6.9%, down from the 7.8% in the preceding quarter. The August 19th to August 26th poll of 52 economists showed forecasts range from 6 to 8.1%. The latest numbers will be released on Friday this week. So there is an evident slowdown in the economy in the last quarter. Rating agency ICRA has projected the year-on-year expansion of GDP to fall to a six-quarter low of 6% in the first quarter from 7.8% in the previous quarter. And this is thanks to a contraction in government capital expenditure and a dip in urban consumer confidence. The ICRA estimate is lower than Reserve Bank's GDP projection. An Axis Capital report signed off by its chief economist said that India's first quarter gross value add growth could be 5.8%, and more on that difference between gross value add and gross domestic product shortly. According to Axis, personal consumption, government consumption, and investment have all weakened. Axis says GDP growth could slow to 6.6%, adding that at this stage, the weakness could be attributed to election-related uncertainty and slowdown in government spending, both capital and revenue. The report also sounded somewhat unsure about the near future, saying if growth momentum did not improve in the next few months, the annual growth forecast of 7% could be at risk. I reached out to Aditi Nair, chief economist at ICRA, and I began by asking her why she was predicting lower GDP numbers and what was the forward implication of her analysis, including for interest rates.
It's quite an interesting quarter actually. We are projecting a moderate slowdown in the GVA or the gross value added growth. And we're projecting a much sharper slowdown in the GDP growth, which is the headline number. And there are a couple of transient reasons why we expect growth to slow down and one specific technical factor. So on the transient side, basically this was a quarter where the elections were underway and there was a large impact of that on the government capital spending, which saw a contraction both for the government of India as well as for the state governments. And also, rural sentiment remained somewhat uneven and weak in this quarter, which was a fallout of last year's unfavorable monsoon. Both of these factors should actually report a healthy pickup in the second half of the year. That is, rural demand and government capital expenditure. Now, a specific reason why we expect the GDP growth to slow down so much is that last year, there was a technical bump up that came in from a sharp contraction in subsidies, which is not the case in Q1 of FY25. As a result, the difference between the GDP and the GVA growth will probably be closer to a relatively normal 30 basis points in this quarter, as opposed to more than 100 basis points in the previous two quarters.
Okay, so a couple of questions. So firstly, can you walk us through the distinction between gross value added and gross domestic product in the manner that you've described it and why that is important for us to understand what's actually happening?
So typically when we do the bottom-up assessment of economic activity, we go agri-industry services and that adds up to the gross value added or the GVA. To that, an adjustment is made. We add the indirect taxes of the government and we subtract the subsidies that the government has given. And that brings us to the headline GDP number, which is actually a derived number in the manner that I've just explained. So the calculated metric is GVA and the derived metric is GDP. And in the Indian context, what we feel is that when we have large changes in either the indirect taxes or in the subsidies, and this can simply come from quarter by quarter when subsidies are booked in the cash flow accounting that we have, we feel that the GVA actually provides a much better indication of the actual underlying momentum of economic activity.
Okay. And if you were to, look at GVA, let's say from pre-COVID to today, where do we stand?
See, pre-COVID to today, of course, we would not have come back as strongly as would have been the case if COVID hadn't happened. So we've got a few years where a low base has really pushed up the GVA growth. Last year, another factor that helped GVA was not just volumes, but also margins. So for the manufacturing sector, we had a YOY fall in commodity prices through much of FY24. And that pushed up the margins for corporates in many sectors. So that added to the value added. And therefore, we actually had manufacturing growing very strongly last year. This year, that tailwind is not there in Q1. And whether it's there in the rest of the quarters will depend on how commodity prices trend from here on out. So manufacturing is unlikely to show as high a GVA growth in FY25 as it did in FY24.
Right. And if you were to look for the next 2 quarters, and particularly the breakdown of GVA, or overall economic growth, which is personal, government, and investment, how are the individual components looking?
So for Q1 and Q2, we expect that the gross fixed capital formation will show a fairly sluggish trend. Q1, both because of government, which I talked about earlier, and also when we look at the private sector or even the government sector, when we look at the project announcement and completion, Q1 was extremely dull. So we expect this to sort of normalize and government spending to really kick off from the end of Q2 onwards, and this should support the GFCF or the gross fixed capital formation numbers, particularly in the second half of the year. Private final consumption expenditure has been extremely uneven. On the rural side, I already talked about the overhang of last year's unfavorable monsoon. And on the urban side, the sense we've had is that while the aggregate number looks robust, it's masking or concealing a lot of unevenness for different cohorts of urban India. And the sense we've had is that high income, high net worth individuals have had strong demand, strong consumption over the last several quarters. Also, people at the bottom of the pyramid who are just entering the workforce have a strong propensity to spend. The problem has been what we call the missing middle, where you may have one or two income supporting up to 6 family members, and their inflation seems to have had a much bigger impact on consumer sentiment and decisions. Now, interestingly, the last 2 rounds of the Urban Consumer Confidence Survey that the RBI puts out have indicated a dip in the consumer confidence. Now, we're wondering whether this is because of the temporary impact of elections on capex or of the heat wave on retail sector jobs, or if there is something more than that, or if it is indeed, high inflation, particularly for food items, seeping into consumer sentiment. We're not going to have a very clear answer on this until the next round of the survey is out for September.
Right. And last question. So how are you linking this with the interest rate scenario? Global and local. So local, obviously, we've not moved, but globally, many central banks in Europe, for example, have either already reduced, say they'll reduce further. The Federal Reserve says it will reduce now in September. So should we be in sync or not?
So the sense we have is that the Fed is likely to start cutting rates in September. And as far as the Indian growth inflation dynamics are concerned, we are anticipating an undershoot both for the inflation as compared to the MPC's Q2 forecast and for GDP as compared to the MPC's Q1 forecast. So if this is to be the case, then potentially it should open up space for the stance to be changed in the October policy review, followed by 225 basis points rate cuts each in December and in February.
Right. Aditi, thank you so much for joining me.
Thank you.
Will global capability centers or captive centers for multinationals eat Indian IT services companies' lunch? Infosys CEO Salil Parekh, in an interview to the Times of India, addressed somewhat the challenge from captive centers of large multinationals taking away business from Indian IT services companies. The question becomes more relevant today because more and more GCCs are being set up in India or are expanding. There are close to 1,600 GCCs in India with about 1.7 million employees, and the market is projected to reach about $100 billion in about 6 years' time. So the link between GCCs and IT services companies is actually fairly symbiotic and has been. Parekh says, for example, that companies like Infosys have been partners with these GCCs, and they have been so as these companies have been growing in India because many of their parent organizations have been clients of Indian IT services companies for years. Second, Infosys says that these GCC investments have life cycles. Companies that were created, let's say 10 to 15 years ago, want to move on to different areas and they move away from it. So in the last 2 to 3 years, Infosys has actually taken over GCCs which are older. On the subject of GCCs relying on internal resources for Gen AI projects, which is the new thing, Parekh says that Infosys is doing hundreds of projects in Gen AI across industry because it's new. And it's something that many companies, large companies, because it's new that is, want to make sure that they have some ability to drive themselves. Infosys' argument is that as you build scale, the knowledge and depth is where they, that is, Indian IT services companies, are good. And over time, newer GCCs are probably 100th, if not 1,000th of the size of a large Indian IT services company. And therefore, with that scale, it's difficult to have the same level of efficiency or the automation tools that companies like Infosys use. There is, of course, another aspect to this, which is that GCCs are good for the economy because they do create jobs and high value, potentially high paying and more domain centric jobs. So, a recent study commissioned by Captivate, a consulting firm, to GCCs and conducted by Feedback Insights, says India is a prime destination for GCCs, but companies do face significant challenges in leveraging India's talent pool. Some 52% of GCCs surveyed prioritize access to a deep talent pool as a key decision to choose India as a destination, though hurdles remain like cultural and communication differences, regulatory compliance, and infrastructure limitations. On the other hand, 57% of respondents said significant cost savings were a primary driver for setting up GCC in India, and some 255 companies were surveyed. But what wins is still, as the study says, the vast reservoir of skilled professionals across domains, from technology and engineering to finance and customer services, which of course is a win for the country. I spoke with Jawahar BK, managing partner at Captivate Advisory, who also is an old IT services hand, and I began by asking him what the study was telling us specifically and descriptively.
I think one of it is that there is a lot more knowledge globally about the capability and the success of the earlier companies that have come and established themselves and done very well. So I don't think there is a need to sell country like we used to in the old days or do country comparisons in a very big way. All that is done and dusted. So I think it's largely being built on the shoulders and the success of the companies that have come in. And of course, some fairly good publicity done by the Software Association wherever it goes and travels. And I think, frankly, we're all part of a large global environment now. So word gets around, few banks come, more of them come in because they realize that there are many levers in addition to cost arbitrage, which oftentimes is the first one, but very soon they go beyond that. So I think it's just a snowball effect.
Right. So, for someone who doesn't fully understand the nuances here, what would be the difference between, let's say, a long-term contract given to a Wipro or Infosys versus setting up a captive center in Bangalore, Hyderabad, or wherever?
That's interesting because when you say long-term contract, there are also long-term contracts which have a T clause, as we call it, at the end of the contractual obligation, which is option to transfer to the company that is given the business. Many IT services companies do sign the T clause with a hope and a prayer that the T is never actually invoked. Now, the fundamental difference really is that of more transparency, more control, the ability to groom resources over a longer period of time, potentially see lower attrition rates. There are other considerations, of course. Some kinds of work are very confidential and therefore concerns of IP and things like that. But more often than not, it's some of the earlier reasons that I gave, which Also, given the maturing of the market, the ability of these companies to remotely visualize that they can manage large teams in a country like India has also significantly improved and changed over time.
So the projection is that India's GCC market could reach $100 billion by 2030. So I don't know from what number, what's the start point for that? I'm sure you'll tell me. How is the overall talent pipeline looking like? And let me ask this in the context of what we are seeing in IT services, where let's say the most companies are now either plateauing in terms of hiring or even shrinking, the large ones.
It comes and goes in waves. There's overhiring at periods of time, and then as the economic cycles change, you find that you've made too many offers at campuses, and then you go easy on that. If you go back and look at historical data, you'll find that this has happened more than once. So it's not something new. The talent pool for the GCCs comes obviously from the service industry itself as one big source. There is no denying that. They're able to oftentimes pay better, give a better work environment, in some cases, give global opportunities to their employees and things like that. And therefore, there will be people and maybe people who are key people in service sector, in the IT service industry who shift over. That's quite natural. The churn within GCCs and captives, as we call them, in terms of percentage of attrition, is much lower than that of the average service industry attrition rate, as we know. And the reasons are these. I think it's a better work environment combined with better pay. In a way, it will all pan out. So if there are less offers in service companies, there are more offers on the GCCs who are picking up the slack.
Okay, so let me pick on two of the things that your report talks about. So one is the reason why India is a destination. So there's cost efficiency, which majority of the respondents say, talent pool, which is logical. Then there's IP protection on one hand. On the other hand, the challenges are culture and communication, which in your study, it's almost 84%, compliance, infrastructure, and then security, that's cyber security and so on. So if I were to ask you to pick one, the one challenge and the one, let's say, opportunity, what would they be for the growth of the GCC industry?
See, the opportunity clearly is that many GCCs come in with one or two programs in mind and will soon realize that there are many things that they can achieve with a long-term vision within the country. Long-term, when I say, it includes investing in people, investing in, like the service industry did, right? We went to the colleges, took freshers, groomed them, spent 6 months training engineering grads on how to code before we put them onto programs. So much of investment went into that. The GCs came in and just did a lot of lateral hiring. But now the ones that have stayed and are looking at long term are also looking at similar programs, etc., to establish themselves. New maturity model for GIC would be Captivate Talk Office 1.0, 2.0, 3.0, where you move from a command and control model, which is the initial historical model that most GCCs came in with, to a more collaborative model to ultimately setting up centers of excellence. While setting up these centers of excellence, obviously these COEs then become global hubs for whatever capability that they are working on or building. And that is the opportunity that many of the GCCs are realizing that they could see. The second being that it's not that you come here for the talent to get your work done alone. You can nurture talent that can be available to you globally over a period of time, right? And there are quite a few examples of senior executives who've got global roles over a period of time in larger organizations which are otherwise facing global talent shortage. Those are a lot of the things on that side. In terms of the challenges or the key focus areas, as we would like to put it, it's interesting that culture and communications came out right on top. It's also not surprising, right? Because the cultures are different, especially if you look at European countries versus Indian ethos. And how do you blend the two? Very often, people have come in with the mandate that, look, you must understand my culture. But the reverse is also true. You need to understand the local culture as much And there are now, over a period of time, many successful programs to do this cross-cultural orientation and understanding. And those that don't do it will face the pressure of finding that their GICs are not growing the way that they should. So I'm not very surprised that cross-cultural and communication too. How do you communicate? It's interesting, right? If you look at organizations overseas, they're very flat in structure. If you look at organizations in India, they're very layered because young people like to see hierarchy. They like to see themselves being progressed and promoted ever so often. So how do you marry the two? If you don't do that well, you can again potentially end up in a situation at a later stage which you can't handle. So I'm not surprised.
Couple of last questions. So one is, what's the pipeline like right now? What kind of companies are you seeing come in right now that's in middle of 2024 where we are? I'm talking about new investments. The second is, if I were to ask you for, let's say, one or two instances of GCCs who you think have been very successful in India in all the ways that your report talks about. They've managed culture, they've managed compliance, infrastructure, cost, talent, everything, and they've got truly integrated. So what would you suggest?
Well, yeah, there are many names, so I wouldn't want to call out one or two. I think there are many successful stories and which have been published, available in public domain. And what they've done right are, if you really look back at the key focus areas that the report talks about, they have done right by most of those areas. And I think that's what has enabled them to be successful and to be able to grow. Leadership, for example, is another one that was called out. The maturing leadership today is a welcome sign because in the earlier days, it was hard pressed to find leaders who could switch off from a service industry mode and switch on to a GCC mode where leadership requirements are very, very different.
What's the pipeline that you're seeing right now? Yeah, in terms of newer investments coming in.
Frankly, our focus as a company, because we spend a lot of time in this space, is with mid-sized companies which are sub $2-3 billion or dollars kind of size. But we are seeing and hearing traction across all segments, not just the ones that we are focusing on. And it's interesting that even smaller companies are looking at opportunity to, even if it means setting up a small team of a couple of hundred people, they're seeing value in it. I think this whole movement to Gen AI, artificial intelligence, etc., people are looking for talent now across the globe. Also, what's happened is because of the effects of COVID, one of the outcomes that we've all realized is that it doesn't matter where talent is sitting because you're not sitting in the office anymore, right? Because for a couple of years, India showed that nobody needs to be in office, your work will get done. So that is another important facet that is enabling more and more companies to come. And we are seeing, it's hard to say what industry. We're seeing engineering, we're seeing back office requirements, seeing insurance companies that haven't come in here yet, telecom companies, the works.
Jawahar, thank you so much for joining me.
Hey, you're welcome.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.